The main goal was just to make the home loan application process easier and provide better structuring. We want to make sure that they're not going to get capped out.
The team that's making sure that that lease that they have in place is all-encompassing and protects the investor.
Exactly right.
I've called the broker and said, look, why are you holding a finance clause deal against a deal that has to settle?
I'm scared already.
The client has $800,000 in cash to pay 20% deposits on all the properties. So how does he structure the properties? He crosses them, all three of them.
Why?
Unbelievable. G'day, Nick. Thank you for joining us on the Property 360 podcast and sitting down with us and having a chat.
Thanks for the invitation.
You're welcome, very welcome. Last time we spoke, it was great. So for those who don't know you, Nick, would you mind telling us a little bit about yourself, who you are, what you do?
Yeah, no worries. So I'm one of the directors of the Lending Lab, which is a mortgage brokerage here in Australia. We're tech-based, so we're very focused on doing things a little bit smoother than what it would be previously and making that experience better than going direct to the lenders. So our business essentially is looking to make the application process simpler, provide better structure and advice, and overall a full financial solution rather than just one product from the lender.
Perfect. And you guys are kicking some goals in that space.
Yes. Yeah. Super busy at the moment, which is great. A lot of investor customers, a lot of activity in the market. Just overall, there's a lot going on, which is good.
So perfect. So just on that and the investor customers, Nick, was that a strategy that you guys set out to implement to be in that investor market?
Yeah, well, it was certainly a big part of the strategy. So when we first set up the Lending Lab, the main goal was just to make the home loan application process easier and provide better structuring. And then where we've found ourselves niching down to is that investor space, mainly because we're very familiar with the investment space. Both myself and Fabian, who own the business, we're ex-business bankers, so we're used to structuring in the more complex parts of it. So we've niched down now where we're helping people get the first investment property, but also help them with the 10th investment property, commercial property, self-managed super. So we're really looking at all of those different investment areas. Yeah.
Excellent. Great job. So you're seeing a lot of that. You're seeing a lot of customers returning back to your business after post-purchase.
Yeah, 100%. Yes. So what we're looking to do is we're trying to set up a bit of a strategy. So they get the first property and then they can move into the second and third. And we want to make sure that they're not going to get capped out. So a lot of people, they buy the first investment property and if they go direct to the bank, normally the bank crosses it with their owner-occupied property. Not a great strategy. Everything gets tied together, gets messy. They may choose the wrong repayment type, may not have an offset, all of that. So what we want to do is set them up correct for the first one, so the second, third, fourth, fifth, etc. is structured correctly.
Yeah, and look, Nick, I can definitely, support that those comments that you made, because we definitely have some very happy clients that have come from the Lending Lab and in particular worked with you. It's very interesting, those few sentences that you just put together there, because, in our experience, we've worked with many different brokers and we've worked with some of the biggest and most awarded brokers in the country. And we've always been given this assurance that, such and such brokers looking over everythh that these brokers do. Although that's said a lot, it's very rarely actually, it's actually very rarely come true. So, without slinging mud, one of the things that we saw recently, once again, been sworn black and blue that this was definitely reviewed and checked by the biggest brokers in the country anyway. So I referred a client across. There was 3 properties to be purchased. However, 2 were off the plan and 1 had a finance clause. The broker was delaying one of the properties that had been called to settlement because he wanted to get an approval for a property that was under a finance clause.
Yeah, right.
It was heading towards Christmas. You know what Christmas is like within the banking
Everyone's
industry.
gone. No one's there. Yeah.
So then so it goes over Christmas. Penalty interest accrues. Penalty interest accrues to $13,000. I had one look at I've called the broker and said, look, what are you doing? I said, mate, why are you holding a finance clause deal against a deal that
has to settle?
It gets worse.
Mm-hmm.
It gets worse.
I'm scared already.
The client has a couple of $100,000. When I say a couple of $100,000, I'm going to say, $800,000 in cash to pay 20% deposits on all the properties. So how does he structure the properties? He crosses them, all three of them. Unbelievable.
Why?
Unbelievable. Now, if you ask, let me ask you, Nick,
Yes. Yes.
in that set of circumstances, do you think that's the best way to structure the deal for that client?
No.
Yeah.
No, they've got the deposits. There's no need to do that. There's no better rates. There's nothing you can access that you couldn't access if they've got 20% plus costs. There's no need to cross those properties over. You can keep them separate.
And just taking it back even further to your background, what we've found in our experience, many years ago, I was a broker. When I was a broker, application forms were 4 pages, 100 points of ID and supporting documents, very minor credit notes, no NCCP, no best interest duty, and the rest of it. Yeah, so that's how long ago I was a broker. So just on that now, there does seem to be a lot of brokers in the space, but there is a huge difference, what we find, in the brokers that come from the banks, or the business bankers, or the brokers, or the lenders, in comparison to the guys that were accountants,
Yes.
didn't like accounting, were something else, and the rest of it. So how do you feel that banking environment sets you up to branch out into this self-employed space?
Well, I think when you're in a bank, you have one policy and one set of credit guidelines, yet multiple different customers with different scenarios, different set of circumstances. The way the bank sets you up to come into broking is you can't look for different products, but you can look for ways around the policy and how we make the policy fit our deal. So it's more a matter of, we have this individual who may not completely fit the bank policy, and as bankers, we have to find a way, okay, they've got the trust here, they've got the company here, how can we structure this, and how can we do really strong credit notes to actually get it through? Where can we seek exceptions? Where is the bank lenient? And it's those type of negotiation skills with the credit team and knowing where to push in that policy that gets the deals done. Because if you've come, and this is nothing towards a lot of good brokers who have come from other spaces, if you have to learn that as a broker, it's a lot more difficult, right? Because we've got at least 45 residential lenders to play with, and that's a lot of policies to know where to work things out. Now, most of the time, the software, we can find a home for it, it's going to tell us where to place it, but the skill that needs to be built, and it might take a bit longer if you haven't come from a bank, is knowing, okay, well, it almost fits here with this major, rather than going to that non-bank lender or private funder. I just have to seek an exception for this one thing, and the customer gets a much better rate, much more optimal structure, rather than ending up at a non-bank lender or somewhere else just because the broker didn't know where to press.
Yeah.
So that's probably one of the main things. And also, we see a lot of different companies and trusts as business bankers, a lot of different structures, a lot of creative tax solutions and whatnot. So seeing all of that and being able to work with that when someone else is paying you and you can spend all the time in the world on these deals, you can really learn how they work and all of the different bits and pieces around the trusts and companies, and we can bring that across to being brokers.
Brilliant. So Nick, in regards to property investment and
Yes.
your clients, you're quite active in supporting some commercial transactions for your property investor clients. Would that be correct to say?
Yeah, quite a few. Yeah.
So tell us a little bit about your experience and the pros and cons or the differences between the residential investors and the commercial investors.
Yeah, for sure. So I'll start off with pros and cons of commercial.
Sure.
So one of the pros, much higher net rent. So the tenant's paying, in most leases, tenant pays the majority of the outgoings, sometimes even management, sometimes if you're lucky land tax. They cover all of that. And you have quite a high net return of maybe 5.5 to 6.5, depending on where you buy. Now the loans are at similar interest rates, at similar pricing structures at the moment as well. So for example, an interest-only investment commercial loan is around the 6.7, 6.8 mark. Interest-only investment residential, around the 80%, it's about 6.77.
Wow.
So the loans are the same. Cons of commercial, you either need to have a lot of equity or a decent deposit, because we can normally only borrow unless you have your own business 70% of the property value. So it's a decent amount more equity and capital we have to put in, and that can be a barrier to entry to those better returns for some people. On the residential side, pros are lower deposit, sometimes wider product mix, so it might be easier to fit in to some of the residential products versus the commercial. But the cons are, if it's a 5% gross on the residential property, then we have to take out the expenses and maybe some maintenance and some other things, and it might turn into a 2 or 3% net in Sydney. Other places it can be up around that commercial rate, but it's a little bit of a lower return in terms of just the rent.
Perfect. Excellent. Very, very detailed, Nick. So just on that, one of the things that you mentioned there is 70% unless you've got your own business.
Correct, yes.
Did I pick that up?
Exactly right.
So tell us more about that, because that's interesting to somebody who has a business.
Yes. So the way that we can structure different levels of debt when you have a business is we can do some of it unsecured. So there's some major banks at the moment, quite major banks in the space, who are happy to lend up to 3 million and do up to 100% LVR, sometimes including costs on a commercial property for investment. So if your business is strong enough to service, we can go with one of those lenders and buy a commercial property with no money down, completely financed, at relatively strong interest rates as well. Alternatively, if we need to borrow more than that, a deal we structured recently, customer was buying a decent little strip mall in Byron Bay, a bit of retail, a bit of industrial behind, a bit of a mixed kind of use premises, few vacancies, needed a little bit of a higher LVR level. So we were able to do 70% on the property itself, and then we did 5%, just a little bit of a top-up, secured against the business as unsecured. So he needed that little bit of an extra LVR. We're able to give them that boost and get them into that property at very good rates as well through a major. And it's by having that business, we can access potentially borrowing that extra money against the business to make up that purchase price. So we could effectively access 100% LVRs in commercial through mainstream channels that aren't overpriced.
Very sharp. Very
sharp.
Yeah, very sharp. So look, Nick, let's talk about some of these commercial property investing clients that you have. Are you seeing them leapfrog, leverage, purchase multiple properties in the? Can they be as fast as residential portfolio building? 100%. A lot of them are subdivision projects or strata projects. So we can buy something that's all on one title. Some old person's owned it for 40, 50, 60 years. They've never touched it since it's been built. And you look at it, and in the current market, if we were to maybe, one we looked at for one customer was a bunch of industrial units in like a upside down U shape, all on one title. If we strata titled those out, immediately it was a 50% uplift per unit. So I think this customer was looking at $2 million instantly after just strata title in, straight after settlement. $2 million, just for everybody else. So
$2 million profit.
Uplift in the value.
Yes, correct.
So just let's step through that slowly. So the old industrial units pre-strata was worth,
I think it was about 4 mil.
4 mil. Strata process, roughly how long does it take and costs involved?
Oh, you've got to get a valuer out and a few other people
3
involved.
months, 6 months?
3 to 6 months maybe.
3 to 6 months?
Yeah.
Then reval?
About $100,000 in the hole, yeah.
$100,000.
Yeah.
Not bad for a $2 million uplift.
100%.
But hang on.
Yes.
The $2 million uplift is a capital value.
Yes.
How many individual units has this property now produced?
Well, the benefit of splitting them up as well is sometimes if there's a bigger space, we can split that in half. We get a higher net rent for each side rather than the space as a whole. So by doing that subdivision project, we're not necessarily lifting the rental yield of the property, but I think it was going to be split up into 6 or 8 units across that one property. So decent number of little properties which the investor can then sell down if they want to, retain ownership of the properties they want, potentially reduce debt levels. There's a whole lot of things that they can do.
Perfect. And so what I'm hearing there is this definitely a job for a professional team.
Oh, 100%.
So this is a job for a very skilled set of buyers agents, advocates, property investment advisors, and a great mortgage broking team to step all the way through that, keep track of that and make sure that they get the result. So Nick, the majority of people are talking about residential.
Yes.
And residential makes the news.
Yes.
So let's face it, whenever the news is about vacancy rates, it's about capital growth, it's about the housing crisis at the moment. And we're going to go into residential in a second. But just before we switch over to residential, Nick, let's talk about commercial. It's very, very well documented that right now we're undersupplied in residential housing.
Yes.
There's a lot of pressure on the market, okay? And vacancy rates are at an all-time low pretty much across the whole country. So how does, in your experience as a broker that's got your foot in both camps, how does that translate, or is there a translation right now for commercial? Are we seeing those tight vacancy rates in those commercial markets as well?
Yes.
Yeah, right.
100%. So depending on the area, we're seeing sub 1% vacancy rates in commercial. It's very similar to residential. It's looking where we have limited stock. Those areas that are potentially close to the CBD and in optimal locations, the vacancy rates are quite small, but it all comes back down to the property, right? Like you can buy an apartment in Sydney that may not go up other than with inflation, and you can also buy commercial property in Sydney, retail shop, might not be in an optimal location, may not have parking, might be difficult to keep tenants, and it also won't go up. But if we're looking closer to the city, not maybe necessarily within it, the vacancy rates are very tight, very tightly held commercial property as well. We've got big companies that are coming in that want this industrial space, such as I saw on the way in, Amazon, I believe it is looking to buy up some very big commercial lots out near Eastern Creek so they can ship TVs faster to people in Sydney.
Yeah.
So it's those types of people in those types of markets and people who need to be close to the city because that's where their customers are based out of. They need their warehouse or whatnot close as well. Those vacancy rates are extremely tight because if they leave, unless they're upgrading their space or downgrading, there's not really much reason for them to shift out of those properties.
Perfect. Brilliant. Loved it. So let's talk about, so when the economy now,
Yes.
right? People don't know. A lot of people are confused. 1 minute CBA's forecasting rate cuts.
Yes.
Next minute
Increases.
Increases. So, and the economy, it seems that everybody's trying to get a gauge on what's going on. Are we going good or are we going bad? And there's a lot of indicators that are giving mixed signals and hard to interpret. So, the way we look at residential property, and predominantly that's the space that we've worked in, when the economy does go bad, tenants and homeowners, homeowners, if they have to sell, they then become tenants.
Yes.
Tenants, if things go well for them, eventually they become homeowners.
Yep.
The majority of the safety net that we find around residential property is it's keeping a roof over a family's head.
Yes.
Okay. So for those who are, in our audience, have been very much focused on residential property and they feel very comfortable there, what do you say to those people? And in your experience, have you seen any delinquencies, arrears, and things like that with these commercial properties? What are the tenants like, and how does the impact of which way or which direction the economy is going play out for those tenants and investors? Yeah,
for sure. So in commercial, it does very much come back down to the tenant itself. So when we're looking at the properties, a good location's important. The right non-specialised asset is important as well. So we're looking to avoid childcare centres, petrol stations, potentially. Things that are harder to let back out if they were to go vacant and that business wasn't to succeed. So for example, a warehouse, right? It's a couple of walls with a roller door, can suit many different businesses. So we're looking for versatility in the market. That's one of the safety nets, because if that tenant leaves, can we refit that? Or is there a make good clause in the lease that the tenant has to refit that, bring it back to standard, or we can get someone else in of a similar business? But coming back to the due diligence piece, when we're looking at the property, we also need to be looking at the tenant. We need to look at what industry they're in, how's that industry going, how long have they been there, etc. We have to also analyse their position, because if that tenant leaves, if it's non-specialised, it's relatively easy to fill the space, but we have to do that extra level of due diligence to maintain that comfort. So with residential, we have the privilege of, tenants are relatively easy to find at the moment, and the leases are a bit shorter. Where with commercial, we have that person for 5 years. And most people, right, if they've signed a lease for 5 years, they're tied back to their business. If their business fails, like I saw in the news yesterday, there were a couple of retail shops that failed out near Parramatta and Hoxton Park. If those businesses fail, there's normally personal guarantees back to the directors. If they've got everything invested in the business, then your property's going to go vacant because there's no recourse there, right? They're just going to go bankrupt.
Great point.
Yeah.
So a lot of this and the security
Yes.
and the due diligence, I could be wrong here, but I'm going to say that all comes down to the team around you.
Correct.
In particular, the team that's making sure that lease that they have in place is all encompassing
Yes.
and protects the investor.
Exactly right. Yes. Yeah, it's very important that all of that's lined up correctly, because otherwise, if it's not, and if the due diligence hasn't been done, then we can run into issues where, it's a bit of a drama.
So that's great, Nick. So the commercial side of property investing is becoming, historically over 20 years.
Yes.
I've been in this business for 20 years. The focus has not really been in that commercial space.
Yes.
Although I can imagine over the last 20 years, there's been a lot of commercial investors watching everybody flow into residential and bank checks.
Yes.
And smile and be very, very happy. So it's great how mortgage brokers are becoming more aware of that commercial space. 20 years ago, I could be wrong, I don't believe there was as many brokers in that commercial space. I think it was definitely the place of the banks. And when I was working as a broker and the rest of it, we had some commercial bankers in there later, and sort of more in the 2000s and 2010s, for example, and they all had some unique and quirky qualities about themselves.
Yes.
But okay, cool. So in the residential space,
Yes.
Nick, in terms of success stories and things like that, Property 360, who you've looked after some of our clients.
Yes.
We focus on certain fundamentals and key characteristics. Rental yield is definitely one of those. But I just think if you're trying to be in residential property for rental yield, I think you're in the wrong place. I think rental yield's really important, but residential property to me, and the way that I see it, is that the residential market is roughly made up of 70% of the market are people that either own their home outright or are paying off a mortgage.
Yes.
The other 30% is made up of renters or investors who own those properties, and so you can find that data. That data is pretty much available in a lot of places. So our philosophy has always been, we want to work in the house space where this is a house that a family will love now, and in 10 years or in 20 years, it might need a lick of paint or a reno or the rest of it, but it's still in a good location. It's still a house that a family's going to love. When it comes to residential, we want to be really aware that if we start to play around with high rental yield residential property, we then start to operate in a place where the foot traffic is reduced by 70%. So the asset's value is linked to how much demand there is for somebody to buy that asset.
Yes.
And so if 70% of your foot traffic in any industry that you're trying to sell something walk straight past your product, you've only got 30% left. So then it can get even worse than that, because the 30% that are left, they don't have to buy.
Yeah.
They don't have to house a family. So that next 30%, they're going to be sharper, and they're going to be less emotional in their negotiations for that product.
Yes.
In residential now, we do see a lot of people out there coming up with new products. And I'm not going to say that as a whole, all of these products are unsuccessful, but we have seen some very interesting products come into the market more recently, co-living and things like that. I can see how that product can get sold, and I can see why people would move towards that product, because we know that residential yields are tight, interest rates are high. In our personal experience, most of those products that we've assessed, they just come with way too much risk.
Yes.
And the yield difference from a standard house that's suitable to a family to a co-living property, for example, you really need to break it down, because if you're going to put 3 or 4 people into a house, those are individual people. Individual people seem to move around a lot quicker.
Yes.
So therefore, if these people are moving around and moving in and out of the property, then the property manager is probably the one that's making the most money out of this.
Reletting fees.
Because if you really break down that yield, hey, if this is fully occupied and it's fully occupied for the majority of the year and the rest of it, this is the yield that you're going to get. The individuals as well, they could, depending on the area and things like that, they might be late on rent once or twice. They may not be, but you've got to understand the profile of your tenant.
Yes.
Then if all of them move out in one particular year, then your yield is going back to a standard residential rate.
Yes.
But what the trap could be for the client, it's not always the case for the client, but what the trap could be for that client is they've now just built a specialised property in a residential area that doesn't suit a family anymore. And so therefore you're playing in the residential space, but you're not really.
No.
And I don't think people really assess that risk.
It's a specialised commercial property. People don't realise. They see it and they go, it's residential. It's a residential house. It's not. The fit outs, how it's built, it's essentially very comparable to a childcare centre.
Yeah.
Different zones, and they're very hard to convert back.
Very hard.
Yes.
Very hard. So, you've worked with some of our clients. You've worked with some of the clients that have been on our books for quite a while.
Yes.
So you've seen the type of work that we do. I think it would be safe to say that the assets that we've chosen over years are probably tracking around that 7% or more as a compounded figure. So if you look at when you're looking at doing the refinances and the rest of it, you can see the purchase date and the current date, and if you work that all out backwards, it looks like these guys are on track for that kind of that doubling set of figures. And an example, I guess, more recently is you've just seen some of our clients who implemented a strategy that we used a while ago, and we still use it a little bit today, but we were purchasing unregistered land.
Yes.
This particular location is on the border of Kingscliff. So some people may or may not know where Kingscliff is. Kingscliff is just below Coolangatta. It's the New South Wales border, beautiful area. So Kingscliff there on the border. So Nick, you saw the purchase price and the current valuation. So let's just step through that quickly. So the purchase price was?
Just under 400.
And the current valuation was?
So market value is around 700.
700, fantastic. So, what we see there for that particular client is there is no requirement for them. In this particular case, they've decided, hey, we're close to retirement. We'll bank that, we'll take that, we'll sell that block. And it's on the market for over 700 at the moment. Offers above between 720 and 750. That particular client decided to say, hey, thanks, Julian. We'll take that money, we'll bank that. And in accordance with the advice from our financial planner, that little profit there will come in very handy for our retirement goals, which is cool. But if those people then decided to move forward to build, a good broker can use the value uplift, correct?
Exactly right.
Step us through that. So they've put down 10%.
Yeah.
Fast forward to settlement date, they've made $200,000 or just under in uplift. For the people who don't understand, how does that work now from a structure point of view for these people to fund the build?
Yeah, exactly. So in that example, depending on what their build contract is and depending on the lender, we can look at the new value of the land based on market value, not for what they signed the contract for. So in that particular example, what we did for that customer who wanted to bank the profit was when they went to go settle, they didn't have to put any additional funds in. And we refunded them the 10% they had put in. They put the money, they put it back into the offset accounts, they had it anyway. But because the land had gone up so much in value, it was very easy as long as we selected the correct lender to borrow the money and give them their money back. So not only have they not had to pay interest while that block's been appreciating, while that subdivision's been going on, when they've settled, they've actually received their money back and they have enough equity to either build or pull it out and they could buy another property or sell that block, but they're essentially not out of pocket for that entire transaction because of that equity uplift.
Yeah, perfect. So that's exactly how it's meant to work. Now, there's always risks involved with all these types of things. One of the things that we see in the market at the moment in the residential space is historically, for many, many years, we had not supported new apartment projects.
Yeah.
For us, there was not a market that we wanted to get into. Apartments can be great investments. Generally, when the apartment's been around for 20 or 30 years, or there's a history for the apartment. So you can get into the strata reports, you can see if there's any issues and things like that.
Yeah.
Property 360 strategy is we operate a lot of our time and effort and research in areas that are close to water, and that's generally seawater and salt water. So salt water over time can have impacts on houses and apartments and things like that. Historically, we stayed away from it, especially the huge complexes. For us, there's just so many risks in that. There's the construction risk. It could be 3 years or more.
Yes.
3 years is a long time to take a option out or take a view on a market, particularly when you might be one of 250, 300 units. In 3 years' time, what you paid for that property might have seemed good value, and it might have seemed cheap. And in 3 years' time, it could have been extremely good value, because we have seen the market move.
Yes.
But it can also move against you, and it can also be worth less than what you paid for it.
I've seen that.
The other things that we've seen in those big, huge apartment complexes is that banks will get a certain level of exposure to that building. And then they'll just say, hey, fellas, we're not taking any more risk on that building. That's not necessarily a problem, but it is a problem if that's the only place that you will your client will fit in that product.
Exactly right, yeah.
Now what we see in the market is just like that unregistered block of land. We see that there's not that much construction out there. And we're now exploring different options with land, unregistered land, but also with certain apartment projects. And people are going to hear me say, what? Julian, for 20 years you told us not to go near apartments. And it's served us well, land and house and land and the rest of it and those types of things. But now we're seeing some real opportunity there, because construction costs have somewhat normalised, and there's less projects coming out of the ground. So what is coming out of the ground? If it's coming out of the ground in 18 to 24 months, some big projects could be 3 to 5 years. That's not for us. But what we have seen is these projects that are closer to completion, they are boutique style apartment blocks. So we're not talking about the huge blocks. We're talking about, maybe 15, 20, 30 maximum units in a 3-level sort of complex. So we're seeing some real value in those markets for some clients. Buying off the plan gives them the opportunity to use a small deposit, get their finances in order, and get ready, and hopefully get the uplift. But there's risks to everything, and it's not a strategy that we paint with a broad brush for all of our clients. But we are seeing some opportunity there. Obviously, if you have the money at the moment and your situation allows it, it's a great idea to jump into something that's ready, that they can start collecting rent from on day one. But yeah, it's a different story. So we're kind of seeing that now at the moment. So Nick, what do you see around your local area? I mean, you're just out of Sydney, I believe?
Yes, yep.
Central Coast?
Bottom of Lake Macquarie.
Bottom of Lake Macquarie.
Very top of the coast. A lot of new stock.
Lot of new stock.
Lot of stock.
So when you see a lot of new stock, let's go through, this is actually a great point. So let's go through this lot of new stock. So when you say a lot of new stock, some people listening might not understand exactly what new stock means. So new stock meaning new subdivisions?
Lots of new subdivisions, big ones.
The usual suspects, like the big guys, right? So we're talking about master plans, 10, 15, 20, 30-year master plans?
Yeah.
Okay. So let's have a chat about that and where you see the dangers in that area that has a lot of new stock.
Where I'm based at the moment is essentially there's a lot of new development. So there was one major subdivision that went in, and with that it brought slightly bigger shops. There's a new childcare centre going in. And on the back of that project, there's been a lot of different developers who have now come in, bought up a bunch of land, and there's a lot of subdivisions. So from where I am, there's roughly 3 brand new subdivisions. One of them is basically as far as you can see. If you stand at the fence, you can see all these big major roads they've put in. There's areas that are going to be new shopping centres, and it's all going to be very new. However, it's taking a very long time to put together, and it's a very long time horizon. Now, there's where those subdivisions end, all of that land behind there, when that eventually comes up, it's going to be sold. It's going to be exactly the same as the blocks that have just been cut, and they're just going to continue to cut. So we're going to have all of these blocks that are exactly the same size, an unlimited number of that stock that could last, 10, 20, 30 years with the shopping centres. But the problem is what people are paying to buy these off-the-plan properties in these areas where there's all of these new subdivisions, it's exactly the same now, minus obviously build costs might be slightly different than what it's going to be for the next one. So the values of these properties are suppressed and they're not seeing the uplift because they can just continue to keep building the same thing, copy-paste.
Yeah, it's a great point. So we never really work on those what's called greenfield sites.
Yes.
Because they actually are hiding to nothing. They're probably a great place for a family to start out a life, but for investors, they come with challenges. Mm-hmm. One of those challenges is supply. So you want to make sure that the supply and demand factor is in the odds are in the favour of your client or your investor. And if it is a 10-year or 15 or 30 years, Queensland and Victoria in particular, if you go into the western side of Brisbane, you've probably got 100 years worth of land in the west.
Yes.
You've probably got 100 years worth of land available north heading to the Sunshine Coast. And these are the types of areas that a lot of companies are trying to sell these co-living products and things like that. But they are really just paddocks and they go on and on and on. And so the developers who have bought these paddocks, if the market changes in 5 years' time and they need to shift some land, because holding onto land with no income becomes expensive. There's a whole range of issues. They could make their block sizes smaller, sell them cheaper, and then effectively dilute the market for the other people that have already purchased. So it's quite a dangerous place to play.
Yes.
In those big subdivisions. They look good. There's literally tens of thousands or even millions of dollars spent on marketing. But from an investment point of view, when there's that much supply, it's really not an area that Property 360 would advise our clients to buy in.
Yes.
Okay, Nick, thank you for today. Fantastic.
For
as always, a good chat. A little bit early this morning, a little bit dusty, but thank you very much. I look forward to working with you in the future. Thank you so much for all of your insights that you've produced for us today. It's fantastic.
Thanks for having me on, Julian. It's been great.